Hello and welcome to the Commodities Institute podcast. I'm Emily Costa and today is January 14th, 2026. Thank you for joining me for a deep dive into the forces shaping global commodity markets right now, because what we're seeing is not just about supply and demand, it's about strategy, security, and a growing willingness by major economies to lock in resources even when the world feels uncertain. Let's begin with energy, but not where you might expect. Instead of starting in the Middle East, I want to take you to East Asia, where China has quietly rewritten the record books on oil imports. December capped off a year in which China imported more crude oil than ever before, both on a monthly and annual basis. December alone saw nearly 56 million metric tons of crude arriving at Chinese ports, equivalent to more than 13 million barrels per day. That is not just a seasonal bump, that is a signal. Over the full year, China imported roughly 558 million tons of crude oil, averaging more than 11.5 million barrels per day. What matters here is not just the volume, but the reason behind it. Refinery throughput increased, yes, but stockpiling played an outsized role. China added hundreds of thousands of barrels per day to storage throughout the year, filling new tanks built by both state-owned giants and independent operators. Energy security is clearly driving this behaviour, especially against a backdrop of geopolitical tension and discounted barrels linked to sanctions. Lower prices also helped. Chinese refiners paid, on average, significantly less per barrel than the year before, creating an incentive to buy now and store for later. By late December, onshore crude inventories climbed above 1.2 billion barrels, the highest level on record. Provinces like Guangdong and Shandong accounted for a large share of those builds, with storage facilities linked to major refiners absorbing massive inflows. Interestingly, Russian crude gained ground at the expense of Iranian barrels, highlighting how geopolitical alignments continue to reshape trade flows. Now let's pivot from demand to disruption, because while China was filling tanks, the Black Sea was turning into a flashpoint. In early January, drones struck multiple oil tankers near Russia's Novorossiysk port, a critical hub for exporting Kazakh crude to global markets. These vessels were heading toward a terminal that handles the majority of Kazakhstan's oil exports, and the timing could not have been worse. Kazakhstan's oil and condensate output fell by roughly 35% in the first half of January compared with December averages. Winter storms had already strained infrastructure, and earlier attacks had damaged key facilities. The result was a sharp drop in flows just as global markets were adjusting to higher Asian demand. War risk insurance premiums for vessels sailing into the Black Sea nearly doubled overnight, adding cost and uncertainty to a region that handles more than 2% of global crude exports and a significant share of grain shipments as well. These attacks underscore a broader point. Physical risk is once again a major pricing factor in energy markets. Even when supply exists on paper, getting it safely from producer to consumer is becoming more complicated and more expensive. From oil, let's move to agriculture, where China once again dominates the story. In 2025, China imported a record volume of soybeans, exceeding 111 million metric tons. That represents a solid increase from the year before and reflects strategic buying behavior rather than simple consumption growth. Early in the year, Chinese buyers accelerated purchases from South America, particularly Brazil and Argentina, driven by fears that an extended trade conflict with the United States could disrupt supplies. Those fears proved well-founded, as shipments from the United States effectively stalled for several months. By the time December arrived, soybean imports were broadly in line with expectations, but logistical delays at ports caused temporary shortages for some crushing plants. What's notable is how quickly trade patterns shifted again once a truce was reached late in the year. Purchases of US soybeans resumed, with China committing to buy substantial volumes by the end of February. To make room, the state stockpiler began auctioning soybeans from its reserves, selling more than 1 million tons in recent rounds. This tells us that China is not just buying aggressively, but actively managing inventories to balance domestic supply with diplomatic commitments. Wheat tells a similar, though slightly different story. China boosted imports from Australia and Argentina in December, taking advantage of low global prices. While domestic harvests have been strong, quality issues in corn crops mean China still needs clean grain for animal feed. Australian and Argentine wheat, priced competitively, filled that gap. Traders believe sustained buying could eventually tighten global oversupply, though for now, the market remains well fed. Turning to metals, China's influence is just as pronounced. Steel exports surged to a record monthly high in December as producers rushed shipments ahead of new export licensing rules set to begin in 2026. For the full year, steel exports reached an all-time high, even as domestic demand softened due to a struggling property sector. Those exports, in turn, supported demand for iron ore. China imported a record 1.26 billion tons of iron ore last year, driven by low inventories and better margins at steel mills. Looking ahead, analysts expect global iron ore supply to grow further, potentially putting downward pressure on prices if demand does not keep pace. Rare earths added another layer of complexity. Despite export restrictions imposed earlier in the year on several key elements, China's total rare earth exports reached their highest level in more than a decade. Shipments dipped temporarily after controls were announced, but recovered as agreements with major trading partners eased tensions. By year-end, overseas buyers had rebuilt stocks, illustrating just how dependent global supply chains remain on Chinese output. Energy markets beyond oil also deserve attention. Coal imports into China hit a record monthly high in December as buyers stocked up for winter and responded to rising domestic prices. Yet on an annual basis, coal imports actually declined, showing how seasonal needs can mask longer-term trends toward balance or substitution. In Japan, nuclear power re-entered the spotlight after regulators paused the review of a major plant due to falsified seismic data. The delay complicates Japan's efforts to reduce reliance on imported fossil fuels, which still account for the majority of its electricity generation. Energy security, once again, is at the heart of the issue. Finally, in dry freight, Russia raised its grain export forecast for the upcoming season, but with a warning. Poor harvests in southern regions and logistical challenges from inland areas could limit how much grain actually reaches ports. Even with a large national crop, geography and infrastructure remain decisive factors in global trade. When you step back and connect these threads, a clear theme emerges. Governments and companies are prioritizing security, flexibility, and optionality. They are stockpiling when prices are low, diversifying suppliers, and accepting higher costs to reduce risk. For traders and policymakers alike, understanding these motivations is just as important as tracking headline numbers. That's all for today's episode of the Commodities Institute podcast. If you found this episode valuable, be sure to subscribe, share, and leave a review.